The spectacular Microsoft is now down about 30% or so since it began its decline back at the end of 2021, which puts them at a market cap of 1.8 trillion US dollars, a PE of 26, and a dividend yield of just 1%. And they've now just reported their Q2 2023 earnings results, which have seen a 4% increase in the stock price after hours. So it's time for us value investors to analyze the results so we can get a better idea of where things stand with Microsoft and to see if we should be religiously buying this conglomerate or if we should wait for lower prices. Make sure to stick around to the end of the video as we'll answer all that and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. Throughout this video, we will walk you through the fundamentals, the top line, bottom line, balance sheet, cash flows, and finally we'll conclude this video not only discussing the trajectory of this business, but also the buying points at which we value investors should be stepping in to buy this stock. So if you enjoy this type of content, make sure to like the video, subscribe, as it really helps out the channel, and because we post on here regularly analyzing the businesses you want to see most. Also make sure to start a discussion in the comment section below, and without further ado, let's jump into the video. Okay, so as we mentioned, Microsoft's Q2 fiscal 2023 earnings results. What new information did they provide us with for this quarter? Well, we'll start off with revenues that came in at $52 billion for this quarter. Now that is a 2% growth year over year on that top line. Now that's nothing that's going to really excite investors, but when we look at this from a constant currency perspective, it is a little bit different here. It is about a 7% growth on a constant currency perspective. Obviously they are dealing, like everyone else, with those foreign exchange impacts here. So we have seen a deflation of about 5% to get to just 2% growth for those revenues. Gross margin came in here with 1% growth, but again, on a constant currency perspective, about 8% growth. That's actually pretty good here, especially from a gross margin perspective. 8% growth on a year-over-year basis is always something as investors we're going to be salivating over, especially if a business like Microsoft can continue that going into the future. I mean, it's definitely something we'll have to keep watch on over the next few quarters. Finally, when we get down here to our operating income here, they came in with about $20 billion worth of operating income for this quarter alone. That's actually a negative 8% growth rate there, meaning that their operating expenses, in order to operate this business, have been increasing. We'll talk about that more in just a few moments, but on a constant currency perspective, at the very least, we are flat year over year. It's actually not too bad there. Now, the bad news doesn't really end there. Let's talk about some more bad stuff here. Their more personal computing segment really did not perform well this quarter, especially since they had Windows OEM revenue decreasing 39%. Their devices revenue decreased another 39%. Search, news, advertising, those costs actually had increased. Xbox content and services decreased 12%, not looking good at all, at least for this segment here. But their productivity and business processes saw some decent growth here. They did acquire LinkedIn not too long ago, so those revenues are also increasing as well, up 10%. Their intelligent cloud business is also performing quite well. So these results definitely offset those poor results there on the more personal computing. Now, when we take a step back and look at this from an income perspective, we bring down that total revenue figure of about $52 billion. You can really see this disparity here between product and service revenue, where services is where Microsoft is really able to capture the most amount of revenue. Once we break that down a little further, we can see here, as we mentioned, those gross margins have actually improved, right? Mainly because their cost to produce those products actually decreased, at least for this quarter, and especially if we look at this from a 6-month perspective. The same can't necessarily be said for their services, and that's why we actually did see a slight increase there on their costs of revenue, but that's fine, especially when we've seen the nice growth in revenues that we have seen so far for this year at least. But what I want to bring your attention to down here is their operating expenses. In order to operate this business, each quarter they do have a lot of competition that they are competing with for market share, and so they do have to spend on things like research and development, sales and marketing, general and admin, and so those expenses definitely ate up a little bit of that operating income. And ultimately, when we look at this from a 6-month perspective, we actually are down from this time 1 year ago. Not by much, but about 500 million or so from a business that you would kind of expect growth from, despite the macroeconomic environment. Now, we already touched on the constant currency reconciliation here. So let's jump over into our balance sheet. On this channel, we like to look at the balance sheet from a perspective of cash versus their debt. Can they pay off their debt with the cash that they have on the balance sheet? And well, we can see here that's an astounding yes for Microsoft. If we look at this snapshot in time from December 31st, 2022, they have about $100 billion in liquid cash just sitting there on the balance sheet that they have a lot of different things that they can do with. Now, when we take a look at their debt though, they have about $44 billion in long-term debt. Okay, so if we add in the short-term debt of $4 billion plus the 44 of long-term, it's about 48, let's just call it $50 billion in debt. Very, very healthy balance sheet here with double the amount of cash on the balance sheet than they do have debt. And that's why when we get down here to our cash flow reconciliation, you can see what's going on behind the scenes. Well, I mean, for this quarter, at least they were able to produce about $11 billion in cash from operating the business. They spent about $6 billion of that in order to maintain and sustain the business. And so they're left with about, let's just call it $5 billion in free cash flow to reward shareholders. Last year, this time though, they did have about 8.6 billion. So that is about a 43% decrease year over year, which is actually primarily due to their provisions for income taxes. But aside from that, if we look at our financing activities, how they reward their shareholders, we can see there's two main things that they're really focused on here, and that's repurchasing their shares. They used up about $5.4 billion, let's just call it $5.5 billion on repurchasing stock, and another $5 billion on paying out a dividend to their investors. From a 6-month perspective, you can see how that looks. And then the other thing that they kind of have to do here is pay down that debt that they do have. I mean, it is $50 billion, it's a decent amount, but when you take into consideration the cash that they have on that balance sheet there, they're able to service these kind of rewards to their shareholders without taking on more debt. So that is a good thing. And they can just pay down debt with that cash that they have as well. Now, when we get down here to our operating income, we can see there has been that expansion in growth year over year over year, all the way since 2015. So we can expect that in the future with another decent quarter that was just produced from Microsoft. So if we plug that figure into our calculator, let's assume they can grow up to $85 billion in a challenging environment this year, at least in terms of operating income. If we require a 10% return, they do currently pay a dividend. And given the challenging environment, if they can only grow at, let's just say 5% for the next 5 years, that drops down to 3% for the 5 to 10 years after that. On a 25 PE like they're currently trading at, the stock should be worth about $261 per share. Right now, we're trading at about $240 per share. So we could say we're fairly valued right now for a normal growth rate environment where they're only growing at about 5 to 3% for the next decade. Now, in the very best case scenario, let's go back to our 5-year EPS growth metrics down here. They were growing at 24%, especially pre-pandemic. So, I mean, if we bump these growth rates up to an optimistic 18% growth for the next 5 years, I know that is quite a bit, but if we assume that there's going to be a rebound in the economy at some point, let's say their personal computing segment actually increases there, more buyers come into the market there, they're willing to spend more, people aren't being so frugal. Let's just say in the very best case scenario, they can achieve about 18% for the first 5 years. That drops down to, let's just say 10% for the 5 to 10 years after that. On a 30 PE, the stock would be up to $630 per share. Massive, massive growth there. But if we want to be just a little bit more realistic, let's just say they can only grow at, let's just call it 13% for the first 5 years. That's still optimistic there. And then that drops down, let's just say to 7%. Yeah, it would still be worth about $473 per share in the very best case scenario. Now, I wouldn't really follow these projections too much here because they are rather lofty. I would probably say a more realistic, optimistic scenario here would be like 8% growth, and then that drops down to about 5%. And then you could see $360 per share, which is right at around those levels we saw back in 2021. So definitely something that is achievable for them to get back to those all-time highs. Now, in the very worst case scenario, if we assume that there's more pessimism to come for this stock and the global macroeconomic economy, let's assume for the next 5 years, they're not able to grow at all. In fact, they decrease on their fundamental results by 1%. Then finally, we have that economic rebound, let's say 5 years from now, and they're able to grow at an average 6% growth on a 20 PE. The stock would be trading at about $190 per share. So a decent drop off from where we are. But I think this is your margin of safety investment level here. Now, you do have to take into consideration this business is trading at 1.8 trillion US dollars. That is massive valuation there. And it's because everyone knows this is an amazing business, fundamentally, huge market share, a massive global business. So it's the same thing with Google. It's the same thing with Apple. Really, people are going to come in here and buy it up, knowing that it is the business that it is. So you have to take that into consideration, and it has to be something you understand as a potential investor in this business. It's going to be harder for you to actually own these shares at a margin of safety because people aren't going to be willing to let it get down to, cheap valuations. But that's the analysis for this video. Let me know what your thoughts are in the comment section below. Are you a buyer of Microsoft? Do you currently own Microsoft? And what videos do you want to see next? With all that said, I'm going to give Microsoft about a 7 out of 10 in terms of an investment, simply due to the fact that it is, like I mentioned, an amazing business on one hand, great fundamentals, lots of cash, but on the other hand, I know it's overvalued and I'm going to have to pay up for the business, whereas I'd rather purchase shares typically at a margin of safety. That's the analysis for today's video. Make sure to like, comment, subscribe, and I'll catch you on the next one.